Good morning, everyone. I think I am live and all good to go. Wait, I say good morning. Well, some of you could be the middle of the night, in the evening, in your APAC, because I know we have people all over the world showing up for the great marketing growth debate. So listen, we couldn't be more excited to be doing this again. For those of you who have been along with us in the beginning, this is our second session of what will be a 7, 8, maybe more series to come. But again, welcome and thank you for joining us. Listen, as some of you know, and I have the great privilege here of introducing today's discussionist, expert, marketing growth theorist, I guess. But as many of you know, Pete Fader from Wharton was back on the 24th. Today we've got Dominique Hanssens. I'll give a further introduction to him here in a second. Byron Sharp coming up in September. That date's actually going to move, by the way, September 24th. Just we'll get that out to everybody. And then Joe Rubens on October 14th. And as I alluded to last time, there are more coming. We have found somebody who's doing some phenomenal research into really understanding what really drives growth with a unique data set, which we think is powerful. The other thing I sort of mentioned to you too is that if you're not aware, those of you who are members and close to us, especially those of you who sit on the board of the MMA, are aware that we have a research initiative that we're launching to really understand what is the relationship between brand and performance marketing long term. How do those interoperate? So if you have an interest in that topic, you'd like to know more about that research initiative, which we've just kind of paused here for a moment, given sort of the dynamics of the pandemic, then please feel free to reach out to me. I'm Greg at MMA Global. I don't see my name here, but my email, but it's just Greg at MMA Global. Please feel free to do that. But more coming. We will be announcing very soon, too, who will be on the marketer debate sessions in likely October. Then there will be a group of analytics people who will debate these theories in November, and then also finally wrapping the whole program up either into December or into maybe 2021 will be CMOs debating some of these theories. So we couldn't thank them enough when we get ready to announce them. So listen, again, I do have the great pleasure today of introducing Dr. Dominique Hanssens. Dominique is at he's a distinguished professor of research at the Anderson Graduate School of Management at UCLA. He's been there for a number of years. He's written a number of papers. I have some of them even here with me. One of my favorites, though, is his work around empirical generalizations about marketing impact. So I think that gets more of the complexity of this space than almost anything else. And part of what we're trying to sort of establish here and sort of presenting these growth frameworks, at least the world's leading growth frameworks, to the marketing industry at large. Listen, as you don't know the format, Dominique's going to share for about 30 minutes his positions, some of his perspectives. We'll let him do that. And then Joanna O'Connell has graciously agreed from Forrester to come sort of talk to Dominique, sort of ask some questions from the audience, or ask some questions ourselves and sort of probe a little bit deeper there from that. And then, again, Mark Vermute, as we did last time, the Vice President of Marketing Solutions at Newstar, is going to come back, and he will reflect some of your questions and so on. So listen, we definitely encourage you to submit, which is sort of just my next and last slide. If you have questions, if you have some sort of perspective or something, if you can figure out the On24 platform here, I strongly encourage you to do that. There's many sort of features. In fact, I don't even need to give you all of Dominique's profile. It's there. Joanna's, everybody, tons of information within this platform to help you keep you busy and understood sort of where we are. So again, with that, without further ado, Dominique, Mike, I'll turn it over to you to roll. Appreciate it. Thank you very much.
Okay, thank you very much, Greg. And to everybody, it's a pleasure to be here. And as the title suggests, I'll talk a bit about long-term impact of marketing, of course, and that relates very strongly to the theme of all of these sessions, which is about how marketing drives growth for our companies. By means of introduction, let me bring in, an old favorite of many of us, and that's Peter Drucker. And he once famously said, "Marketing and innovation produce results, and all the rest are costs." Well, is that really true? And with our digital age, is that really true still? That's overall sort of a set of questions that I'm going to try to answer. And how do we really answer that? Well, we really need two things. Fortunately, we have them. First of all, we need good marketing data. And over the past 20, 30, 40 years or so, that has happened, as you all know. And in addition, now we have all the digital data for the last 10 years or so, so it's getting even better. But you need more than data. You also need frameworks, ways of analyzing the data, so you don't get basically results that cannot be replicated. And that's where the field of marketing science comes in, which is a field that I'm active in, as is Pete Fader, who spoke to you a few weeks ago. And in industry, marketing science has become marketing analytics also, as you know. So there is not only interest in the academic community, but a great deal of high-quality practitioner work being done. So in tackling this question, I'm proposing to do two things. Number one is, look, marketing generates revenue in several ways. We know that. The first way is through specific actions, decisions that you make around the product, the price, the distribution, and the promotion, which includes advertising. Okay? And I'll take a look at what we have learned about these actions. And then secondly, marketing, or good marketing, also creates assets. Like, for example, it can create a strong brand or strong customer relations. And I'll take a look at what is the long-term value of both brand equity and customer equity. Now, to try to do that, that's, of course, quite a bit. And so I'm going to have to kind of try and simplify that a bit and come up with some numbers that actually are comparable, so that the different companies that you all are engaged with, they may be B2B, they may be B2C, they may be international or domestic and so forth, so that the results can be compared to each other. So how do we do that? First of all, with respect to marketing actions. Look, over the years, we, and by we I mean the entire community that looks into that, both practitioners and academics, have learned a lot about how sales performance responds to marketing spending. And what I'm showing you here is a fairly typical curve. I'm not saying it applies to you in any given situation, but sort of fairly typical, where you have the sales there, the top line, and you see that it's not a straight line. Why? Because of the phenomenon of diminishing returns to scale. So that tends to be the relationship. The more you spend, the more you sell, but at a diminishing rate. Well, that has very strong implications for your profit. What's your profit? Well, or at least contribution to overhead. Well, that's your sales times your gross profit margin minus your marketing spend. When you do that little bit of math, you get a profit curve that looks like an inverted U. You see that there, which means there's a zone where you're underspending. In other words, if you spend more, two good things could happen to you. One, your sales go up. Two, your profits go up. But there's also a zone where you overspend, which means, yeah, your sales go up, but it comes at the expense of lower profits. And that's what I call overspending. Okay? Now, in business, as I'm sure you're very familiar with, we like to use terms like return on investment to go figure out where we are somewhere. And I'm not going to use ROI for the following reason, because that is so dependent on profit margins and cost structures, and as a result, it's very difficult to generalize that. Rather, my numbers are going to be with respect to that top line there, that sales curve, because all the rest then follows from that. And I'll do that with a very simple number that you know if you've taken an economics class at one point or another, and it's called an elasticity. And that's sort of a percent change in your results divided by the percent change in your spend. So let's take a look at where that brings us. This is a very simple overview. It's got only 6 or so numbers on it, but there's a lot packed in here. To the left there, you see the different things that marketing invests in. And then you see what I call typical elasticities, and then some comments about long-term growth drivers. Now, first of all, where do these numbers come from? They don't come from a single study, because that would be just an anecdote. Rather, they come from studies of studies. In other words, if people have looked at, let's say, the effect of prices, what have they tended to find, and how have others who have also looked at prices either found the same thing or found deviations from that? And in so doing, notice that I'm taking a broad definition of marketing, not just advertising, in other words, but the entire marketing mix, which is going to be important, as I will show you later on. Let's take a look at the first two there. 2 forms of marketing communications, ads of various kinds, and sales calls. Well, the typical elasticity is about 0.1 for advertising and 0.3 for sales calls. I'll give you the references later, by the way. You can look that up. And first of all, what does that mean? it means that if you were to double your ad spend, so 100% increase, then all else equal, you're probably looking at about a 10% increase in sales. Not profit, sales, okay? But if you were to double your sales calls, well, then your sales might go up by something like 30%. So the sales calls are more effective than the advertising. That's the good news for sales calls. But of course, they're also a lot more expensive, as you well know. So that doesn't mean put all of your efforts in sales calls. There is some sort of an optimal mix between the two, which is actually given by the ratio of these elasticities. So that means that both of those are subject to strong diminishing returns. That means you got to be very careful about overspending. And even though it may work, let's say the ad may work, just doubling it again and doubling again and doubling again is not going to continue to work and produce the same ROI level. That's very, very important. Okay? Now, incidentally, these numbers, of course, I call them typical. There are, of course, ranges. But the ranges are relatively well clustered. For example, typical ad elasticities, they go from about maybe 0.01 or 0 if the advertising doesn't work at all, to maybe a maximum of about 0.3. Okay? And that maximum is only when you have new products. In other words, you're telling your consumers something that they don't already know. That's terribly important, and that's going to connect this, of course, to innovation, which I'll talk about a little later. Okay? But now compare these two top elasticities there to the next two, which are two price drivers. One is just price, simply price, and the other one is price promotion. And by that, I mean a temporary price cut. So you say, this week, 20% off, that sort of thing. Okay? Now, look at these elasticities. They are much, much, much higher than the two communication elasticities, advertising and sales calls, which is another way of saying that you get a much stronger consumer reaction to actions with respect to price and price promotion than you do with respect to the other two. Now, does that mean that you should put all your efforts in price management and promotion management? Well, no, as you see to the right there, no, for the simple reason that price movements are very easy for competitors to innovate. You can lower your price in an effort to gain market share. Next thing you know, your competitor does the same thing, and you're both back to square one, only with lower profit margins. So even though the reaction is strong, the strategic ability to use these drivers for long-term growth for the company is limited. I'm not saying it's zero, but it's limited. And it's very, very limited for price promotions. The rule is in price promotions is when somebody promotes, let's say for a week or 2 weeks, yeah, you gotta, hey, that particular competitor gets a bump in sales. The others may suffer a bit. And then after the promotion is over, what do you see? You go straight back to the situation before the promotion. In other words, nobody tends to get a long-term benefit from that. That's a strong finding also coming out of the literature. And now the next one there is distribution. So what's distribution? It means availability of your product or service, broadly speaking. So in B2C, it means how many stores are you in? And in B2B, it may mean how many markets in the global market do you have a representative, or do you have an office? Do you have an office in Japan? Do you have an office in the United Kingdom, and so forth? So forms of distribution. I showed two numbers there because the relationship between sales and distribution is not concave like the others are, or convex. It is actually an S shape. That's why I have to give you two numbers, 0.6 to 1.7. Now, look at these numbers and compare them to the others. And you see there that the ability to produce sustainable growth is going to be more driven by these high elasticity than by these low elasticity drivers. And that is something that I'll elaborate on a little bit more. That's why I call them major. Finally, with respect to innovation, it is very strong, but the results are so much all over the place that we don't really have that many strict results on that are quantifiable. But we do know that there is a positive effect of innovation on the value of the firm. So in other words, companies that innovate a lot, even though that's costly to them, and they may have short-term pressures on profit because of that, they tend to be more highly valued by investors. So there is a strong positive effect of innovation. So let me now take these results and take it to the next step Before I do so, I'll just give a brief reference on where this comes from. The Marketing Science Institute in Boston a couple of years ago published this little booklet that I edited. It's called Empirical Generalizations About Marketing Impact. That's the one that Greg said he liked. Thank you, Greg. I think it's a very useful little booklet. It's available from Amazon. It's actually pretty cheap. And it's got about 120 of those fundamental findings in there that I just gave you maybe 5 or 6. And this book has about 120, all of which are driven, as I said, from studies of studies. So lots and lots of replication so that we can enhance our learning. Okay, so far for the overall marketing mix. Now, a lot of us are saying, look, with the digital age, with the world of the internet, etc., everything is changing. And so then the question is, well, are these results really still valid, given that so much has changed in our marketing world? Right? And I'm going to briefly touch upon that in the 4 areas there that I list. And I think some of these have really quite remarkable conclusions. Let me start with digital media, because we've seen a lot of innovation there, whether it's search advertising or Facebook advertising, mobile, social media, etc. What has resulted in terms of responsiveness to advertising as a result of all these movements? Okay? Well, actually not that much. And I don't mean to say that these new media don't work, they do. But I'm saying overall that the response elasticities are very, very comparable to what we found years ago before the internet. Okay? And we have to be just very honest about this. It's all persuasive communication. And persuasive communication is important, but it can only do so much. So for example, there's a wonderful sort of illustration of that. If you were to set the clock back to the 60s, and you look at, let's say, American firms on average, so the American economy, you say, how much do American companies spend on advertising? Just as a simple question. You would find that the answer is, on average, 3% of revenue. 3%. Okay. Now set the clock to this century. Maybe not during these COVID days here necessarily, but let's say the first 10 or 15 years of this century, and you ask the same question. And you would find that the answer is 3%. Okay. That has not changed. The media, of course, have changed, but the overall value of the persuasive communication is very, very stable. Okay? Even though we have some wonderful new developments there, like, for example, an old medium like TV advertising can drive people to the web, and that's interesting, as well as some new challenges there that I can get into if there are questions. So not all that much difference in terms of advertising. But now, how about product quality? Well, look, consumers have always valued, good value for the money, which is sort of a definition of product quality, if you wish. What is the difference now in the internet age? The difference is that it's, for us consumers, it is so much easier to get information about the quality of an offering, again, always product or service, before you buy it. And I'm referring, of course, to the numerous online review services that are now available. So some of my colleagues have done an empirical generalization study of, now, what do these product reviews do for you if you're the manufacturer, let's say? Well, if they say good things about you, that's the valence, that's the quality of the review, the elasticity is about 0.69. But look at that. Look how high that is. The advertising elasticity is 0.1. The review quality elasticity is 0.7. So in other words, getting reviews that say good things about you is very, very powerful and can lift, let's say, a 10% improvement in the quality of reviews, raises your sales by 7%. That's very substantial. And even just the number of reviews you get, regardless of whether they're good or bad reviews, has a positive elasticity that's pretty high. Okay? That's the fundamental difference between, I think, the current information age we live in and prior generations in which it was really difficult for consumers to understand quality before purchasing a product or a service. And I think that will actually continue to evolve. Third point is, how about diffusion? How long does it take for a new product, to diffuse through a market? If you set the clock back many years and you go back to the early part of the 20th century and you look at, I've done that in some work of mine some time ago, and look at, let's say, how long did it take for dishwashers or washing machines or refrigerators to reach maturity? In other words, where everybody who is ever going to have one now has one. Okay? And the answer is over 30 years. So if you were starting your career working for a dishwasher company in those days, 1910, 1920, something like that, you could have an entire career, a 30 or a 40-year-long career, and every year your sales would be higher than the previous year. But that's no longer true. And the reason is, of course, that because of information quality and availability, you see much, much faster diffusion. For example, let's take a highly successful product like a smartphone. Okay, how long did it take smartphones to conquer the market, so to speak, and to be into a very large level of adoption with multiple innovations on top of that? And the answer is probably something like 5 or 6 years. I haven't seen the exact number, but much, much shorter time period. So therefore, the diffusion principle is still there, but it's going so fast now that the whole concept of where on the life cycle am I is perhaps losing some relevance because of the information age. And then finally on distribution, I would say as follows. I have a nice quote there for an article that has done a very, very good job at illustrating the effects of distribution. Well, what I'm saying in the digital age is that we now have a very different form of distribution, which is much less expensive. And I'm referring, for example, to having an app on your smartphone. If your bank, the bank that you use has an app, and you have that app on your smartphone, then basically your bank travels with you wherever you are, and you can make transactions anywhere in the world because of the app. And that's sort of a form of distribution that I think is fascinating to observe. And I've not really seen strong research on it in terms of the, for example, the elasticities. But since we know that distribution elasticities are very high to begin with, I think we need to pay particular attention, not just to digital advertising, etc., but the ability to get your app representing your company or your service onto consumers' real estate, if you wish, their smartphone, and being able to be with the customer at any point in time. I think that's a wonderful expansion of the distribution concept into the digital age. Okay, so that's my summary of what we've learned about how marketing impacts performance through specific actions. Now let's take a look at marketing assets, and that are different from short-term revenue or long-term revenue even. Now there are two that come to mind. The one, of course, everybody always likes to talk about is how strong a brand do I have, or the brand equity. The question that I'm asking here is, does it really matter to have a strong brand from a financial perspective? Is there a long-term impact of strong brands? The other one is a little different, and that is how satisfied are my customers? And the reason why I put that down as an asset is, satisfied customers become more loyal. Loyal customers buy more and more repetitively, and that creates customer equity. And I'm connecting here with the material that my Wharton colleague, Pete Fader, talked about several weeks ago, where he really dug into this whole customer equity concept. And I'm glad he did that, because now I don't have to do it, just to point out how really important it is. So completely agreed with Pete's perspective on this. Now, what have we learned about the financial and long-term impact of these assets? Well, I'm going to point to two major studies here. They're also of the generalizations type. But first I need to say that if you want to know the value of these assets, you really need to look at how they impact the value of the firm. And so therefore, this work is strictly done on publicly listed companies. I'll talk about private companies a little bit later. At the University of Michigan, Professor Fornell and his team were experts on customer satisfaction. They've done many studies, but I'm picking one here that sort of drives the following point home. Suppose you had some money to invest in the year 2000, and you put it in the S&P 500. Okay. And let 15 years go by, all the way till 2015, I think. And by the way, that includes the big stock market crash of 07 and 08. How well would you have done? You would have gotten about a 31% cumulated return. So it's positive, but it's not really great because of that huge crash in 07, 08. Okay? But suppose you had invested differently. You had invested in companies that have rising customer satisfaction. Look what your return would be. It would have been over 500%. Okay? Now that drives a very strong point home, is that any investment in customer satisfaction, which then of course generates loyalty and equity, turns out to be very, very rewarding in the long run, and a major growth driver in the modern economy. The reason for that, by the way, is that it's relatively easy to prove that, for example, if you were to increase your loyalty from 80 to 90%, meaning every year 80% of your customers come back versus every year 90% of your customers come back, you actually can show with a little bit of math that just that 12% increase would actually double the long-term value of the company. So it's very, very powerful. Okay? By the same token, two German researchers have done, Idling and Fischer, they did a recent study on, again, across many, many other studies on finding, well, what's the elasticity of brand value versus customer relationship value? How does that relate to your stock prices? And look at these numbers. They're positive and they're strong. And what's even more important is that while brand is important, customer relationship is even more important. Meaning, if you have a 10% growth in your brand strength versus a 10% growth in your customer relationship strength, your company will benefit more, will benefit both, but it will benefit more from the latter. Okay? These are very important findings about understanding long-term drivers of corporate performance. And a few minutes ago, I promised that I would also take a look at not just at publicly listed firms, but also privately listed firms. And that's one that I was involved with myself a few years ago. So I teamed up with a small company in Switzerland, which it's called Markables. And they do a very simple but very useful thing. Anytime, anywhere in the world, there is either a merger or an acquisition, they collect all the data. And they have sort of this mega database. There were 5,000 mergers and acquisitions in my database when I looked at this. And by now there are, I think, about 11,000, where you can sort of quantify what was the price that this company sold for. Now, here's what's interesting. There are, of course, public companies in there, but there are many, many private companies in there. And when is the only time that we know about the value of a privately held company? The only time you know something about it is when it gets sold. Okay? And so this is data on actually how much people were willing to pay for these companies. And I have then plotted that against two particular drivers. And that comes from the accounting literature. Turns out that when there's an M&A, some of you may know that there's a part of the accounting profession which is called purchase price allocation. They walk in and they do an analysis of, okay, so you paid, let's say, $100 million for this company. What did you just pay for it? Well, maybe $20 million worth of plant, $15 million worth of patents, and so on and so forth. One of those value drivers is brand strength. They measure that. And the other one is customer value strength, and they measure that. Okay? I'm going to skip the details on how they do it, but suffice it to say that this trend that you see there, and which is continuing into this new century of ours, shows the following. That as a percent of enterprise value, again, regardless of whether it's public or private, that the relative importance of brand, it's still there, but it has gone down from maybe 18% of purchase price on average to about 10%. You see that red line go down. Okay? But then customer relationship value, okay, that used to be about 8% of average purchase price. And now it's closer to maybe about 18%, or to put it differently, the two have switched roles. And that exactly confirms the previous study here, this one, that says that brand is important, customer relationship is important, but in this new age of ours, it's the customer relationship value that drives the growth potential, in this case measured by the value of the firm. So I'm ready now to draw my takeaways. what I've done here is, as my contribution here to this growth debate, is a couple of things. I've sort of started with the question that, or the statement that Pete Drucker said many years ago, that marketing and innovation drive results. Well, was he right? Yes. How do I know that? Because all these elasticities were significant. Okay, I can find no evidence that there's a part of marketing that, on average, does not work. Now, there's many, of course, individual exceptions, but broadly speaking, all the investments that we are doing in marketing, broadly speaking, tend to produce results. So that's good. Secondly, the information age or the digital age has certainly changed some patterns, but maybe not as much as we might think, in the following sense. The changes are more with respect to, for example, consumers being informed about the quality of a product or service through reviews. And the fact that these reviews are available on your cell phone or your laptop makes them so much more accessible. And that, as a result, has become a leading driver of growth for companies. So we got to be looking in the area of customer satisfaction, customer evaluation, and so forth. And that's why I say there, marketing and innovation go hand in hand. When do the marketing, let's say the advertising elasticities go up? When are they higher? Well, they're generally higher when you're advertising something that your customer doesn't already know. In other words, for example, you have new availability, you have of course, a new product, you have an improved product. Those are the things that tend to produce the growth, and in such a way that marketing and innovation, as I say there, that they go hand in hand. Overall, other than that, not that much changes in marketing mix effects, I would say. But very importantly, if you're looking for long-term impact of marketing, it comes for the most part from creating these assets. And as I said, there's two of them. There's the brand, which is on the supply side, and there's the customer relationship, which comes from customer satisfaction, and that's more on the demand side. And the evidence is increasing that the customer relationship one tends to now be stronger in impact. Again, they're still both important, but one is gaining in importance over the other. So these are basically the overall kind of principles that I wanted to share with you. I know I've covered a lot. Fortunately, all of that material is publicly available. You see the exact references there if you want to look up some specific sources and learn more about it. And it's been a pleasure summarizing this for you, and I turn it back to the organization team for your questions and answers.
Great. Mike, am I live? I can't tell.
Yes.
Yeah, good. Well, Mike, listen, I can't thank you enough. That was exactly what we wanted to kind of reset. And I have so many questions that I want to ask, but that's not my role here. So with that, let me turn it over to Joanna O'Connell, who has already studied some of your work, some of the other perspectives, and she's going to bring some insight to that. And then in a little bit, we're going to ask Mark to kind of review some of the questions from the audience. So if you have questions, everyone, please feel free to type those in. We're going to get to as many of those as we can today, as quickly as we can. If we fail that, then we will do some follow-up with all of you around that sort of later. But with that, Joanna, I turn it over to you. Thank you.
Thank you so much. Mike, that was, I felt like I was in college. I literally was taking notes the entire time, like a nerd. Super, super fascinating. It's fun to get to learn professionally. I wanted to actually start with an advertising question. I will admit I write a lot about advertising, and so this one is a little bit selfish. But I was wondering if these principles that you talked about and sort of the elasticity of advertising, does the principle hold true when you're talking about something like mass advertising as compared with sort of where we are now, when in digital, the real focus is on this notion of audience and delivering more targeted and more personalized, more tailored messages to specific audiences. So does it matter?
Yeah, okay. Great question, Joanna. Thank you. Overall, yes, the principles apply to both. and whether or not your firm needs to rely more on the digital, the one-on-one versus the more mass advertising, that is highly specific to the case that each company is facing. But it is, of course, a fact that in the whole digital arena, that our targeting ability has gotten so much better, and therefore we're able to do things that we weren't able to do before. There's good news and danger in this in the following sense. The good news is that, targeting, if you do it well, you're more likely to get impact, no question about it. But the targeting also has a danger to it, and that is when it's not targeted well, it has a risk of annoying consumers, which you didn't have earlier in the following sense. In mass advertising, if you see an ad on any medium and you're just simply not interested in it, okay, well, what happens is nothing at all. There's no negative effect, it's just a zero effect. But now with the targeting, it is a possibility, and we have some evidence on that already, that it's possible to get a negative effect. So for example, if a person is really bothered by a particular ad or by what it says, some people actually at Yahoo have studied that and have concluded that if some ads are being targeted that consumers don't like, that they will actually visit the platform less, so that there's sort of a negative repercussion. And that's really the difference. The more that you target, the better. That's wonderful. But at the same time, the riskier, because if you wrongly target, you may get a drawback. But overall, I would say the patterns that I've discussed certainly apply to both.
Well, you're preaching to the choir, as a lot of what I'm thinking and writing right now in the context of the immediate future of advertising is through that lens, sort of all the ways in which we've maybe gotten it wrong or gone too far, and the unintended consequences of that, some of which are annoyed consumers, some of which are regulatory action. So certainly an important topic. This notion of brand, you talked about brand equity and then customer relationship and the value of those things. Can you talk a little bit about this notion of brand and whether the principles that you talked about apply or hold true in this current time in which we find ourselves? So in the midst of a crisis like COVID-19, where it's a sort of a health pandemic, but also there's this kind of economic shock to the system that's happening. Are people more or less kind of attuned to brands that they know and relate to? Does it matter?
Yeah. Okay. We do live in unusual times indeed. Okay. We obviously have no research on prior pandemics, because the last major one was in 1918, and we didn't do that sort of thing back in 1918. But we do know something about what happens to brands during recessions. And basically two things that we have learned. Okay. The first thing that we have learned is that when there's a prolonged recession, you tend to see people who, of course, now have less purchasing power. You tend to see, in some sectors at least, where this is relevant, a switch to private label, which is generally cheaper. But then what happens when the recession is over, and again, it's all about customer satisfaction, if that private label brand is good, in other words, it works just fine, okay, then it can have a prolonged effect. In other words, even though the good times come back and the customer can afford to buy now the big brand again, they don't. So you tend to see kind of a downward push on prices as a result of major recessions. And of course, brands then have to work hard to gain back their prior position. How do they do that? Innovation, okay? Innovation can bring brands back to where they were before at the end of a major recession. But the other thing, though, I want to make one comment about COVID. And of course, we don't really know exactly how long this is last. I'm actually not convinced. Of course, I know that we're going through hard economic times. That's obvious. But I'm not convinced that this is a recession. And let me tell you why. And the reason is that prior to COVID, the world economy, for the most part, was in good shape. It may not have been as good as maybe a couple of years ago, but it was in pretty good shape overall. So there was nothing really fundamentally wrong with the economic mechanisms that drive recessions when COVID arrived. That's one observation. And then the second observation is, at least for the American economy, and I think also for the European and a few others, the federal authorities have really, especially the Federal Reserve, they have really acted quickly and very decisively to try to help people in need and keep the spending to at least a reasonable level. And so it can't last much more, of course, much longer, because we're going to run out of money altogether. But at least for the time being, I think I'm reasonably optimistic that if this does not last much longer, then we should see a return to where we were before relatively quickly. But still, the points that I made about brands there, I think, would also apply.
Yeah, I mean, I would say certainly at Forrester, we're talking to brands about how to market through this. I mean, there's sort of messaging strategies, but fundamentally we're saying keep marketing, don't disappear from people's lives right now.
Yes, that is a very good point. Well, actually, I forgot I'm glad you reminded me of this. If your business performance is a function of your share of voice, which it often is, and your share of, and you keep on marketing, but your competitors pull back. So even though your spending is not higher, your relative spending is higher because everybody else is pulling back. That can create a competitive advantage coming out of the recession later on. So that's an excellent point.
So fascinating. Okay, and maybe something that we will play out even more when we talk to Professor Sharp, by the way. But maybe moving backwards in time to Professor Fader and this notion of customer value. So can you talk just a little bit more? You talked about the relative importance of the kind of customer relationship and the relative value of that. Can you just give us a little more insight into then how brands should be focusing? DTCs, for example, right now are throwing their energy into acquisition. But is it really about, growing the customers you have? Is it a subset of customers like Professor Fader talks about?
Right. Yeah. Excellent question. Look, we all have a tendency in our companies to chase new customers because that's cool. So if you're in charge of that and you can tell your CMO or your CEO, look, last quarter, we had 200 new customers, and then I came on board and changed everything, and now we have 500 new customers. You will look really good, okay? So for all the right reasons. But if you're in charge of retention and you say, last quarter, we lost 100 customers, and through my actions this quarter, we only lost 90, that actually is less impressive. They say, what do you mean you lost 90? You should lose 0, okay? And so, but if you did the math, you could actually, in some cases, find that being able to reduce attrition can actually be more profitable and more growth pushing than chasing new customers. And if you do, I don't have time to do this, but if you do the math, you can actually demonstrate that those are two budgets that should not compete with each other.
Totally.
In other words, it's not that if you have $1,000, you put 200 in new customers and 800 in retention. It's more that the better you retain your customers, okay, the more valuable they become. But if they become more valuable, then you should acquire more new customers because they're worth more, okay? So it's a very fascinating case of when you're thinking long run about value creation. And again, Pete Fader said a lot of interesting things about that along the lines of finding the right new customers, et cetera. Then it is a trade-off between those two that is not as obvious as treating it as a zero-sum game.
Yeah, I mean, if we had more time, I'd love to dig into this. The very hyper-focused energy around the right customers, the most profitable customers, versus retaining customers in general. Do you have any, what's the short answer there? Do you have any perspective on that?
The short answer is go back to market segmentation principles, right? Accept the fact that not all customers are treated alike or should be treated alike, that they're different. Find where you have the best fit with your value offering. And then within that, find out those that have the highest lifetime value potential. And then there are various ways of doing that, by the way, some highly analytical ways to do that. But I think that's sort of, that's the principle, that you should value the customer in the long run and then allocate resources accordingly. And of course, valuable customers are going to be worth more than others. I did a study once some years ago where I showed, this was for an online company, that customers that were acquired through word of mouth were more valuable than customers who were acquired through advertising. Okay. Now, in the short run, acquiring through advertising was more effective because you're in control, and you're in control with your messaging, as you said a minute ago, and that's great. Okay. But then the ones who come in maybe more slowly through positive word of mouth about your company turn out to be more profitable in the long run. So that's another example of the principle of who is the right customer. And it's certainly one that has shown to be strongly related to overall performance.
Boy, as the person who writes about advertising, I think you're giving me a lot to think about, because I worry sometimes that we dismiss advertising in conversations about how to create effective communications with consumers, including, by the way, customers. It's annoying when a customer gets an ad that's badly done or does not respect the fact that they're already a customer. But we don't have time to do too much on that. Last question, and then I want to hand it over to Mark. This idea of connecting brand equity and customer equity to business performance, this is actually something I asked Professor Fader as well. Do you think that the average marketer has been trained to think that way?
What a good question. The answer to that is all over. In other words, some have and many have not. We are still battling in marketing a little bit of a struggle, if you wish, that it's viewed as a touchy-feely area. And it's for the people who are maybe socially very outgoing, but not necessarily analytically very sophisticated. Because if you're analytically sophisticated, why don't you do finance? That sort of thing. We see that sometimes among our students in the MBA program. And then they start to take marketing courses. And then they say, oh my gosh, this is very analytical. I didn't expect that. So in other words, it's a slow process of educating our managers at all levels that there are analytical principles at stake in marketing. And just because you favor creativity, which you should, the creative component is terribly important, doesn't mean that you should let go of important business realities of the types that I've just presented. Okay? So my answer to your question is that it varies all over the place. Fortunately, as time marches on, I see that our executives are certainly better educated than they were in the past. And in the last few years, I would say, judging from phone calls that I get, I would say there's more and more interest in this notion of measuring long-term value of a customer, which is very, very positive and gets us away from this short-term thinking that sometimes plagues our businesses.
I could not agree more. It's one of the reasons I think we're in such a problematic position with digital advertising right now, a lot of short-term. I'm going to hand it over to Mark, because I know that he has a question and he wants to write some questions.
Well, and hey, Mark, I might just mention to Dominic, he's aware. I'm noticing that there's I know some of the people who are asking the questions, and Mike, you got a master class here. You got a few PhDs asking you questions. So, Mark, why don't you pick and choose some of those and they get pretty heady pretty fast.
Yeah,
go ahead. Thanks,
absolutely. Brandon. Absolutely. And I do have to say that 30 minutes to an hour isn't enough of Mike. I had the great fortune of getting a whole semester. And I don't even know if he realized, but my first job was doing valuation and purchase price allocation. So I come from a finance background, and now I live in marketing analytics to help companies make data-driven decisions against measurement and make audience decisions and trade off short-term and long-term. There are actually a lot of questions that have come in, really good questions. A couple are very much aligned around a couple concepts I want to draw back to. What's really interesting is if you think about a lot of the people in the audience, we tend to think about messaging and channel first, and we don't always think about all of the other marketing levers that are at our disposal. I want to bring you back to what you talked about, but dive in a little bit deeper. So the question becomes, you talk about overall marketing elasticity and overall marketing impact, that hasn't materially changed. You did touch on the fact that you need to think about what you message. How do you think about the mix? So if overall marketing is having the same effect, does that mean any channel is the right channel? And then how do you trade off that between the short-term and the long-term impacts of marketing as it relates to promoting brand and customer and product equity?
Okay, thanks, Mark. Okay, so I see two questions in there. So the first one is more about channel and medium. It really does matter, and I really did not mean to imply that $1 spent on all media will have the exact same impact. No, my statement was adding up all the dollars. Yes, right. The media will change according to people's usage. Okay, so for example, TV has done reasonably well in the internet age. Okay, it's still there, still actively being used as a messaging channel. But print is doing less well because print is easily substituted away by digital. Okay, but for example, a lot of newspapers are both paper and digital. So we're seeing kind of a natural evolution of the audience going towards the digital media, and you obviously should follow that. In terms of the messaging itself, well, yes, there is good research that shows that message quality does matter. It's true that I didn't produce an elasticity on this, but I know that it does matter. That's where good market research comes in. That's where figuring out what are the strengths of your brands, what are the weaknesses, what is it that your consumer maybe is misperceiving, that they have a wrong impression about you, and that you need to fix in your messaging. That's all sort of good quality market research, I would say, that supports this. And then secondly, your point about short-term and long-term, look, there's a rule of thumb, which is, I almost hesitate to say it because it's so simple. And it's a little bit oversimplified, but here you go. If you want to know the long-term effect of advertising and you can only measure the short-term effect, it's not a bad approximation to take that short-term effect and multiply by 2. Okay? Some of my colleagues have actually tested that. It's not always true, but it's not a bad number. Okay? But here's what's interesting. If the short-term effect is 0, 2 times 0 is still 0. In other words, you should not expect that a marketing or an advertising activity that does not produce short-term benefits, you just can't see anything, that magically the long-term benefit is going to appear, whatever, 1 or 2 years later or even 1 or 2 quarters later. That is not true. So you really have to look for these short-term impacts and then how these are distributed over time. And I've written some articles on that. It's a little bit too much to summarize in one answer. But yes, there are certainly conditions where you have a sustained effect of the advertising, an order of neighborhood of maybe a few months or so, probably not years. And that means that a certain amount of repetition is needed in order to sort of keep the momentum going, so to speak. That is not true, for example, with respect to price promotions. Price promotions have a very high short-term effect, but we have almost zero evidence, not quite zero, but almost zero evidence of long-term sustained effect. And the reason is, if you offer your product on sale, you're training the consumer to the notion that it's really not worth as much as its base price is. And so then when you do that repetitively, you train your consumer to basically only buy the product on sale. And what happens then is your brand equity goes down. And so big difference between messaging sort of in general versus messaging that is associated with temporary price cuts.
So I think we have time for one more question, because these are deep questions that aren't a yes or a no. But when you talk about distribution and the idea of it, and then you talk about it moving into more of a digital, always-on world, how do you think then of distribution as it actually relates to marketing comms and media channels? When you think about the fact that the same place where you do owned and earned social engagement now has transaction capability built in, where affiliate and paid search marketing is leading you right into the purchase channel when distribution is potentially everywhere. What role does marketing play in making that distribution effective? Or does it muddle how you think about a marketing channel when it's also a sales channel at the same time now?
Oh, I love this question, and you're spot on. It's very powerful. See, because what you're doing here is you have the advertising does not only sell something, but it also makes the product available at your fingertips. And that is very powerful, because you're absolutely right. What you now have is not just an advertising effect. You have a combination of an advertising and an availability effect. And if one thing that we have learned through years of marketing science is that the closer to the purchase occasion you are, the better the advertising works. So if the purchase occasion is right there, it's only a click away, then you're creating advertising and distribution at the same time. Now, I have to admit that in terms of finding generalizable patterns on there, it's still early. I'd like to see more studies so that I can throw some elasticities against this. But based upon what we do know from the importance of availability, by the way, that's my proxy for distribution, it's very powerful. And in fact, all you need to do is look at the success of Amazon. Why is Amazon now making so much money after 10 years or more than 10 years of losing money by the truckload? Okay, it's because they have earned themselves a place where you automatically go to, where everything is available and you trust the source. Okay, that is an enormously powerful asset. The fact that it's always at your fingertips. That's a distribution factor. That is not an advertising factor. And Amazon has had to work for years to build that. And so we're seeing that, again, in the long run, about the outlook for this firm.
One quick follow-on to that, which would be, as you think then about these digital distribution companies, they're all opening physical locations prior to what we're in right now. Can you briefly talk about if that then makes sense? Is that greater availability because physical proximity matters as well?
Oh, yeah. Yes, because even though the digital world is, in theory, unlimited, in practice it is. And yep, the physical, you're absolutely right. Some companies have gone back to good old physical locations, but you also have to kind of take a look at exactly what they do with these physical locations. Let me pick Amazon again as an example, because they have some bookstores now, some physical bookstores. Okay, when you go to an Amazon bookstore, what do you see? You see two prices. Okay, there's a regular price for everybody, and then there's a special price, but you have to be an Amazon Prime member. Okay, and by the way, the discount is pretty substantial. A $40 book is maybe $25 if you're a Prime member. So that physical store not only sells books, but it also sells memberships to the Prime network. And once you're into the Prime network at Amazon, you have access to all of their other services, including entertainment services. So they're very, very clever about that. But I am cognizant of the fact that good old physical presence remains important. And by the way, I think that COVID is really going to help us with that, because we all miss, seeing each other in person. And I think that how much we miss that will be accentuated by this long period of absence of physical interaction.
Well, and that almost sounds like a happy note, suggesting that they're all going to come back together here in, accelerated fashion. So listen, Joanna, we can't thank you enough for the time and energy you put in to sort of make this valuable. Mark, your knowledge is as good as the questions that were asked here. We'll have to kind of follow up and get back out there. There was so much good stuff in there. Dominique, you know what? I think I just want to take a moment and maybe thank you on behalf of the marketing industry, because I think that you have dedicated your life to trying to understand the science of marketing. It's a principle and a theory perspective that the MMA wholly appreciates. We think one of the reasons that maybe our industry hasn't gotten maybe the stature and gravitas that we could is in part because we need to be a better, say, students of the science or masters of that science. So thank you. We couldn't appreciate your life's work and this session today. Thank you for that.
Much appreciated.
Okay. And just so everybody knows, coming up next, we won't even put Dominic in a position to have to tell us why Byron Sharp doesn't know what he's talking about. We'll let Byron present his own story coming up on the next go around. Again, that date's going to move. We'll get that out to you. And then Joe Rubinson has some interesting theories and research around work that he's done, and we'll talk more about in part the research that I mentioned the MMA is looking to do here at some point. So again, I can't thank you enough, everyone. Appreciate it. There is a survey, I believe, that immediately follows. So if you wouldn't mind just taking a couple of moments to, not just so much say you liked it, we appreciate that, but maybe tell us what we can do better, and we'll keep you on that in the future sessions. Mark, Joanna, Dominic, thank you very much. Out, everyone.
Thank you.
Thanks.